Exactly as we have long cautioned, most of the world is now in a synchronized rising inflation cycle, and the major central banks are properly behind the curve. By now, it should be no news to you that interest rates globally are moving higher. In January, we learned quite a lot. The Fed finally told us that their view on inflation had changed quite substantially, and they would raise rates sooner than expected and stop buying bonds faster than previously guided. The market's expectation of what the Fed may do also changed, which resulted in an increase in bond yields and a sell-off in equity markets. Generally speaking, equity markets do not enjoy periods of rising inflation. Historically, in just about all the periods of accelerating inflation, equity market valuations declined quite meaningfully. One obvious reason being that high interest rates eventually slows down real economic activity, and investors sell out of equities ahead of the expected fall of earnings. Rising bond yields and changing liquidity conditions generally also tend to have a negative effect on equity market valuations. Credit markets are also vulnerable, given the insatiable hunt for yield that very low interest rates has led to. We see three broad inflation scenarios potentially unfolding from this point. In the Cinderella Scenario, interest rates increase just enough to stem inflation, but not enough to kill off economic growth and unsettle equity markets. Equities rise modestly, but the US underperforms, while bond yields rise moderately in line with short rates. Demand for commodities remains reasonably strong as economic growth ticks along and emerging markets benefit. The rand stays settled, and inflation in South Africa stabilizes around 4.5% to 5% by year end. This is the best possible outcome, and we apply roughly a 25% probability to it. The big bad wolf scenario is our central case, at around 60% probability. Here, it takes the Fed some time to tame the inflation beast. Equities struggle, but some capital-light companies with low gearing and pricing power can still do well. The relatively expensive US market underperforms the rest of the world. The rand weakens and local interest rates rise to 6.5% to 7% as inflation bites. Non-commodity rand hedges do well for domestic investors, but bonds offer less protection in this scenario. The last scenario is Nightmare on Wall Street, where there is no fairy tale ending. We assign a relatively low 15% probability here, but it is a low probability, high impact outcome. We don't really know how one of the biggest financial experiments in history will end. It is possible that the withdrawal of stimulus sucks so much liquidity out of the global economy and financial systems that markets simply can't cope with the shock. Equity markets crash in line with previous post-bubble events, while bond yields fall and inflation collapses. The great global recession unfolds, leaving emerging markets in tatters and the developed world with a major sovereign debt headache. Remember, deflation is the enemy of the most indebted. The rand and local bonds plummet while domestic interest rates rise sharply. It's an ugly outcome, but certainly not the base case. So given these views and our base case scenario, we still favour select global equities with pricing power to protect capital in real terms in the longer term. We have a low allocation to the expensive US market and are excited about opportunities in tech outside the US, given the large valuation discrepancies. We put a high probability on a correction in the valuation of the largest businesses in the S&P 500, given their sensitivity to US long bond yields. And we protected capital against this outcome through a short S&P futures position. Global bonds are avoided completely and cash preferred. Gold has a reasonable allocation to protect against a worse inflation outcome and any escalation of geopolitical risks. For South African investors, non-rand investments offer the best inflation protection. Investors also stand to benefit from a sizable allocation to very select quality SA Inc. equities on attractive valuations, as well as domestic bonds with attractive real yields. The funds maintain high levels of liquidity with which to exploit the long-term opportunities that expected market volatility is likely to present. Lastly, I want to remind you of the folly of market timing. And while we have flagged some scary scenarios that lurk on the horizon, we are still very excited about many of the investment opportunities that we have been able to find. The forward funds are well balanced between protecting capital against the elevated near-term risks that I've talked about and capturing the long-term inflation-beating opportunities that we can see.